Hello there, I'm Sagneet from ETMarkets.com and I would like to welcome you to our webinar on behavioral finance. Let me start with a small data point. The Indian stock market was depressed for almost all of last calendar, but made a whopping rupees 16 lakh crore for equity investors in less than 3 months. Does that make you say wow? Well, I'm sure some of us managed to grab a share of that profit while many of us did not. Ever wondered why is it that some of us want to buy a stock when some others are actually dying to sell it? Why is it that we run crazy to buy shares in a bull market and stay clear of it when the bears are in charge? Does it look like there is some science working behind it? Our guest in this webinar researches the science to map investor behavior and improve one's approach to money management and wealth creation. Let's welcome Sagneet Kaur, Head of Behavioral Sciences at Morningstar, India. Hello Sagneet, we are looking forward to a very engaging discussion over the next 1 hour. Let me tell you, some 1,200 people have already registered for this webinar and we expect more to join as we proceed. Some of the audience have also started throwing up questions already. But before we take up your questions, we will have a short presentation by Sagneet to set the tone. Meanwhile, I would request those in the audience to keep sending their questions and you can post them on the window at the right-hand side of your screen. Let's take a look at the presentation first. Over to you, Sagneet.
Thank you so much, Saloni. Hi, everyone. So, myself, Sagneet Kaur, Associate Director of Behavioral Research, Behavioral Insights Team, Morningstar, India, and today we'll be talking about behavioral finance, the science in the art of money making. So, just before digging more into this particular topic, I would like to talk about behavioral science department in the Morningstar, from where I belong. So, we are a bunch of social science practitioners and psychologists and behavioral scientists and behavioral economists who work in the area of doing research in the area of saving and investing with different stakeholders of the industry. And doing research is not just the only focus of this particular department. The focus is to bring that research to you guys, to bring that research to the audience itself, to bring that research to the different stakeholders of the investing industry. For that, we do a lot of research and we do a lot of randomized control trials, hypothesis testing, and we see how we can better engage you and bring that research to you, and you all can be benefited out of it. Along with that, we use insights from the existing research as well as the behavioral science research to upgrade the existing products within the Morningstar, as well as to design new and ideate new products for the Morningstar team. So let's now dive into what is behavioral economics. So behavioral economics or behavioral finance. Before getting more into behavioral finance itself, let's talk about what traditional finance talks about. So traditional finance basically talks about that human beings are rational. They're logical, and whatever they decide onto or whatever they go onto, so human beings are basically taken as a rational beings according to the traditional finance. But we are human beings, so we have minds, we have brains, we live in a culture, we influence others, we get influenced by others. So behavioral finance basically takes into account our psychological, our cognitive, our emotional, our cultural, our social factors, our contextual cultural factors into account when we make money decisions or when we make decisions in relation to maybe income, generating income, saving, consumption, expenditure, and investments per se. So it takes all these factors into account and see how these factors basically play a major role when it comes to economic decision making, when it comes to choosing a specific financial choice in a specific life event. So let me give you an example. So you're going for a party, you want to buy a shirt, and it's an economic decision which is related to your consumption. You will buy a shirt, and now you're in a fix that how you will do that. So there are certain ways you basically choose to, certain methods you basically choose to decide onto such simple situations or simple problems like buying a shirt. So I'll give you some examples like what you might be doing. You might be going to taking your past experience, you might go to some store or some brand where you bought last time and your experience with that particular product was good. So now you're doing the same thing now. You're going to the same store and maybe not the same color, not the same style, but you're buying the same kind of shirt over there or from that particular store. Another would be a gut feeling. So somebody, you went to a store and you picked up a shirt and you saw, okay, this looks nice onto me. And this is your gut feeling, your intuition is saying that this looks nice onto me. So I should be going and buying the same. Another could be you see a particular counter in a mall where a lot of people are there and they are buying from that particular counter, maybe a Lee Cooper brand or maybe any specific brand they might be buying from. So it gives you a sense that yes, if people are there, definitely the product might be good. So let's buy from the same counter or from the same stall itself. Another method of choosing shirt or making a decision from where I should be going and buying a shirt is price versus quality. Generally, price is taken as a very good indicator when we make decisions for quality. So when the price is high, quality is good. The price is low, the quality is bad. So such methods we generally use while making decisions. But do you feel the same methods work well when it comes to investing? Because investing, I personally feel that investing is a bit different. Investing is more crazy. Investing is more critical. Investing is more complex and cumbersome. So investing is just not about numbers. It's not just about proportions, ratios, or percentages, which generally the traditional economics talks about. But it's more than that. It's pretty more than that. Why? Because human beings are involved there. Why? Because any investment decision or any financial decision is done by a human being, is done by a human person, a social creature. So how does basically happen? Taking the same example here, same methods we will replicate over here and then see whether this is working, where all these methods which we discussed to buy a shirt are working over here or no. So here's a stock certificate on your screen. So this is one, and you might have seen many stock certificates before as well. So if I say just having a look at the stock certificate, you can give me a sense. Can you give me a sense that whether I should be buying this or no? Whether your gut feeling or your intuition will say that I should go, just having a look at the stock certificate, I should go and buy a particular stock or no. This is dicey. Another could be past experience. So generally, if I replicate the second method which we use for buying a shirt over here, if I bought something in past, now I'm buying the same thing in future, now in present basically. So and it gave me certain returns were there, and now again I'm expecting the same returns. Is it right or wrong? This is again dicey. We'll talk about it. And generally past experiences and relying on the past experiences, they lead us to certain types of biases like hot hand fallacy, like recency bias. And I'll talk more about all these biases in the EPD now. Another could be an example where we are just following and copying others' behavior. So investors generally land up in a situation where they just listen to the overhyped stocks and they go and buy it, and they land up buying overvalued stocks. They land up buying high and land up selling them low. So buying high and selling low is one another problem which occurs when you just, without any research, without any analysis, when you just go and buy and get influenced by what others are doing, and you reduce the potentials to gain more money. And Warren Buffett also once said that the best time to buy in a market is when the market is down, not when the market is up, when the prices are high, when the situations are being, the stocks and the shares are being overvalued. So this is one more aspect which we take into account when we talk about using those methods over here in investing. So as I said, these methods, the ones which I discussed for buying a shirt, cannot be replicated in the investing. And what these methods are? These methods are heuristics. These methods are simple ways or simple rules of thumb which we generally use to make certain decisions. And how these simple rules of thumb are connected to our decision-making structure, our minds basically. So we'll explain that. So research basically says, the human mind research or physiological research behind financial choices basically says that we have a single brain, but we have two different minds. So we have mind 1 and mind 2, and mind 1 is generally called as system 1, and mind 2 is generally called as system 2. And mind 1 or system 1 is basically, it's fast. As you can see on the screen, it's running fast. Mind 2 is pretty behind. And system 1 is basically, it's fast, it's impulsive, it's intuitive. It basically runs on a lot of heuristics or rules of thumbs which we have discussed just now. And we take automatic decisions. We take quick decisions with the help of system 1. But on the other hand, system 2 is pretty slow. It's thoughtful, it's deliberate, it's conscious, it's rational. It takes into account many things to make decisions. This is system 2. And the way we are wired, the way human mind is wired, it's like when we face a particular problem, a particular situation, then automatically our system 1 works first. And we take decisions with the help of those rules of thumb. But the same strategy of using system 1 is not applicable in certain conditions like investing. So we have to use a bit different strategies for different situations and different types of decision making. And we have to use certain different strategies, like using system 1 for different problems, like buying a shirt, going to a restaurant, choosing a meal particularly, are something which we can do easily with the system 1. But for investing, we need system 2. I'll give you an example over here. So for example, you are sitting in a room and you hear a fire alarm, or somebody comes running and say, fire, fire, please move out, please move out. In that particular situation, you will not be so deliberate, you will not be so thoughtful. You will not open your laptop and do the cost-benefit analysis over there. You will leave everything and run. That is what the system 1 is telling you to do. That is what his instinct or gut feeling is telling you to do. But when it comes to, say, investing, you get up in the morning, you open your television, you open maybe the CNBC or any particular television, and you see that they are shouting, buy this, buy that, buy this, buy that, this is good. And so many opinions are being forced upon to you. That time, if you're using system 1 to take the decisions, get influenced by all those what is being getting into your ears, that will influence your investing. That will lead you to a wrong decision. This is the impact. You cannot replicate what you were doing there to what you're doing here. So we have very different methods of taking such decisions. So this is what behavioral science or behavioral economics is doing, is trying to make you understand. So the core focus of behavioral finance or behavioral economics is basically to understand how human beings are wired. Another, to identify various mental shortcuts and various mental quirks which come into play. So when we just falsely rely on system 1 and we take decisions where we might not be taking decisions idly, probably correctly. If you want to take decisions, we should not be taking account the heuristics into account, or simple rules of thumb into account. At that point of time, we face with a lot of people prey, and we face a lot of obstacles which are called as behavioral biases. So another focus of behavioral economics nowadays is to identify what all different behavioral biases we go through, or human beings go through. Another is to develop various practical techniques, interventions, and tried and tested, empirically tested techniques to overcome these biases. Another the fourth important fact which is taken into account by the area of behavioral finance is designing data-driven heuristics. And I'll be talking about more, and I'll talk about heuristics in nature and how we can design, how behavioral finance designs heuristics which are data-driven heuristics. Okay, let's go to another slide over here, which will basically mention about different types of mental shortcuts we use, and we fall prey to different biases basically. So over a period of, say, from last so many years, from last 30 decades, the researchers are basically getting into designing and identifying various behavioral biases. So dozens of behavioral biases have been catalogued by researchers, starting from loss aversion and the problems designed and studied by psychologists like Daniel Kahneman and Tversky. So they started in 1970s from now, so it's 40 years back. They started studying. And they started that area, and they found that loss aversion is one of the important biases which comes into play when it comes to investing. So where we overvalue, where we pick and choose our decisions, where we pick and choose the options, and then we see that how much risk preference we could have around it. So that is feeling more pain from the losses and less gain, less pleasure from the same gain. For example, if I lose 1,000 rupees or 10,000 rupees in a stock, I will feel more pain. And if I gain the same amount, I will not feel the same level of pleasure in comparison to the pain which I got. So many such biases have been explored in the area of investing. So how these biases are taken into account. So for example, we have hot hand fallacy. Hot hand fallacy is where the prevailing positive trend is actually leading to the prevailing positive and actually leading you to buy a particular stock. Because it is positive, you feel that the past experience will follow, and you will again have the same positive response. Choice paralysis. You get confused with so many choices which are there up in the market. Recency bias. You buy something, for example, you have 10 stocks. I have 10 stocks in my portfolio, and from last 3 months, these stocks are not working well. So what you will do? You will basically, you would try, or I will try to just drop out my money from there. Herd mentality. You follow others. You blindly follow others. Which we have just talked about how it influences and leads to buying overvalued stocks. Loss aversion, just discussed. mental accounting, hindsight bias, overconfidence bias. And all these biases are actually refraining a person or an investor to make sound money decisions, sound investment decisions, remaining calm during market corrections, focusing on long-term goals. So these are the repercussions which are happening now with the investors. So this is a complex picture which I have shown to you. You will not be able to read any of the things from here, but this is the complete bunch. After researching, this is the complete bunch I got of different types of biases. There are near about more than 180 different types of biases which are there, which a human being can go through. And I just mentioned very few biases which an investor go through, and they refrain themselves or prevent from making sound money decisions, or remaining calm during market corrections, or focusing on long-term goals. Okay, now I'll pose one more question to all of you. You might be working, you might be working in the investment industry, or you might not be working in the investment industry. Out of your curiosity, you are here and listening to me. So when it comes to experts, like in any particular field, maybe it's investing or maybe in any other field, do you all feel that you also go through these particular biases or any of these biases? That's the question for you. Okay, you might have thought your answers. But when the same question was being asked in many forums I conducted with advisors, with asset managers, with professionals who feel like we are experts, we are professionals. So many such forums were conducted, and a question was asked to them whether you feel that you also go through such biases or no. At that point of time, the answer of maximum people, say 90% of them, said, no, we do not face any of these biases. But we all are humans. We have same brain, we have same physiological structure, we have same brain, same two mind system. One is also there, system two is also there. And we also fall prey. I also fall prey. Though I know this whole area, and also subconsciously and unconsciously, because these all biases run unconsciously, and we fall prey to some or most, or typically according to different situations, we fall prey to certain biases. And the implications might be different. So for an investor, an overconfidence bias might have a different implication. For me, it can have a different implication depending on the nature of the situation, the nature of the problem. For an advisor, it might be different. So implications can be different. Biases could be different. So if investors are facing certain biases, no matter, we might be facing, we as experts or advisors as experts might be facing certain other biases. But yes, we all face, some or the other way, we all fall prey to these biases. So not accepting the fact, which we actually found from a lot of forums when we asked this question, not accepting the fact or avoiding the fact that we can also fall prey to any of these biases is illusory superiority, which is a person's overestimation of his or her own qualities or his or her own abilities. And because of this illusory superiority, they generally fall prey to these biases, but they do not accept it. They do not relate these biases to themselves. This is illusory superiority, and this is very closely related to overconfidence bias, which I'll be just talking about, which anybody, whether an expert, whether an investor, whether a client who knows about behavioral biases or no, can fall prey to. So just before going beyond and then taking that area of what all behavioral biases an expert can go through, or anybody can go through in terms of who are professionals, who know their field from so many years and who are proficient enough to make decisions over there. I'll talk about certain management skills, and I'll take an example of investing field specifically, but these management skills can be applied to any of the areas, any of the fields specifically. So as an investor, if investors or as advisors specifically, I'll take advisors example here. So as an advisor or asset manager, if asset managers and advisors are sitting there, they can be easily able to relate it. So they are multitaskers basically. They have to do so many things at the same time, at the same moment, and that too every day they have to do that. So they have to be like running on to communicating a lot with their clients, understanding them, understanding their goals, understanding what they want, what they don't want, making analysis in relation to that. They have to be very focused and determined. They have to be anticipative of what market is saying. For example, they every day they listen a lot of news and they speculate that what is going to happen in near future in relation to their stocks or the portfolios which they have designed for their clients. They have to have analytical ability. For example, the crude prices, the crude oil prices, they rise or they decline. So what is the impact of that particular economic situation or macroeconomic variable which had happened, and then speculating and analyzing that how this is going to impact the future or the specific stock or the specific fund in my client's portfolio. They have to be decisive every time now and then, because they are not just dealing with one single client. They're dealing with so many people, so many clients. They're designing so many portfolios. They have to be competitive enough. They have to have competitive spirit. They have to be emotionally balanced. They cannot be panicking like their clients. So if the market is going up or market is going down, so they are just, the way their clients are panicking, they cannot panic like that. They have to be emotionally balanced in front of their clients. To make the right decisions, they need to be emotionally balanced. And the last one is, as I said, we all are humans, you and me, everybody is human, so we all go through these behavioral biases. We all face these behavioral biases. So as an expert, so we talked about investors, we talked about the clients in the investing field, basically, the end users. But now let's talk about the advisors or the professionals in the investing field, how they go into these different types of biases and what is the impact of that. So taking into account these biases which a professional or an expert can go through, I've named them as management biases, or the biases which an advisor or an expert would face. So the list could be like this: overconfidence bias, confirmation bias, familiarity bias, fundamental attributional bias, or representative bias. So there are so many biases which we go through and which hamper our day-to-day decision making, which hampers our decisions in relation to how we run and how we decide for our clients. Many other could be time-related bias, present bias, endowment effect, etc. So just keeping it very simple and explaining all these maybe in the next upcoming webinars by behavioral science team, I'll take few into account, like for example, overconfidence bias. So overconfidence bias is when you overestimate your abilities to take decisions in a particular situation because you feel that you are expert, you run your business from say 10 years, 15 years, 30 years, and you are so competent enough to take every single decision for every single client. And because time is always a problem for everybody, so many people, so many clients you cannot pay attention to all the clients at the same time level. So you take this overconfidence bias into account, which is running unconsciously, and you make hasty money decisions, hasty investment decisions. And research also has said that level of overconfidence, the way level of overconfidence increases, the cost of mistake also increases. Another research done within the gender, within the males and females, it was found that males are more overconfident than females. And males, because of that, they have invested. So overconfidence also leads to excessive trading, excessive investments. And it was found that 45% of the males, they invested more, they did excessive trading as compared to female. And as a result, over a period of time, they lost near about 1% of their returns by every year. So if you see losing 1% over a period of time, or maybe over a period of your lifetime itself, how huge is the cost? So as the level of overconfidence increases, it leads to making hasty money decisions and it leads to excessive trading. Another biases could be confirmation bias, where you make belief and then you try to confirm that belief from different information, from different sources, but you want to stick to that particular belief and you look for the information which is conforming to that particular specific belief. Familiarity bias, you pick and choose only those stocks or those funds which you are familiar with, which you are comfortable with, which you have tried and tested, which make you feel secure and safe. Fundamental attributional bias, where you attribute somebody else's behavior to their specific internal factors or personality factors, and if you do the same thing, you will attribute that to the external ones. For example, if somebody comes out to your office and says that maybe a new client is coming to an advisor's office and say, okay, this is, I want to choose something which is more stable, which is more risk averse. So you will probably, from the very first conversation, you will probably speculate and say, this person is risk averse, which is a personality or internal factor. And if on the other hand, someday you feel to be investing in conservative investment structure, then you will say this is because of the market. This is a kind of fundamental attribution bias. Representative bias is something on the basis of, maybe on the basis of your first initial analysis, on the basis of some specific information, you extrapolate a detailed information about the person and then make decisions. And this lands advisors to make faulty decisions and making faulty decisions in relation to designing portfolios and choosing the target population whom they have to work with. They also generalize many behavioral characteristics to different investors, to different clients of their own. They also fall prey to certain stereotypes. For example, that women's prefer less riskier portfolio as compared to men, or when it comes to older and younger people. So with older people, they will generally suggest something which is of low cost, as low cost portfolio, and they generally discuss fees with them as compared to the younger ones. With singles and with couples, for couples they'll generally propose a very conservative portfolio, very stable portfolio as compared to the singles, because they feel that singles are more risk takers and are more efficient in managing risk, and they are independent. So such kind of a biases we fall prey to, or stereotypes we fall prey to when it comes to representativeness. Let's talk about how the intersection between behavioral finance and industry in practice is working. So how investing industry is taking and using insights which are being designed and developed by behavioral finance practitioners. So there I have divided that into 4 areas. One is cataloging investment biases, arbitraging market anomalies, developing tools to overcome biases, exploitation of people's biases for selfish needs. So these are the 4 areas how behavioral finance is actually working and is getting intersected with industry practices nowadays. So taking the first one is cataloging investment biases. So behavioral finance practitioners nowadays who are working in the industry and who are leveraging the industry with a lot of insights, what they are doing, they are trying to understand and educate what all different types of biases are, how we are going to categorize it, and what are the different implications of each of the biases for different stakeholders. Maybe some single bias might have a different implication for an advisor and might have a different implication for an investor. Likewise, another theme is arbitraging market anomalies, and where these investors, where behavioral finance practitioners are basically trying to answer how these behavioral biases or behavioral anomalies or behavioral mistakes, they aggregate into market anomalies, and they land up into problems like asset price bubbles or crashes, or maybe equity premium, or maybe small cap premium, etc. Another area which behavioral finance practitioners are actively working on is developing tools to overcome these biases, and I'll be talking a lot more about how we are using and developing tools in the area of behavioral finance and overcoming different types of behavioral biases. Another area which the behavioral finance practitioners are working on is studying and analyzing how the industry, how the marketeers, how the companies are exploiting people's biases for their own selfish means. So like deceptive ads and hyping a lot many stocks on TV and opaque products. So these are pretty good examples of how the exploitation of people's biases, how companies are actually exploiting people's biases for their own specific selfish means. So now let's talk about how behavioral practitioners are working in the area of developing tools to overcome these biases. So they are working in the area of designing certain nudges, designing automated softwares, designing research-driven heuristics, designing behavioral coaching. Talking about nudge. So if I explain you in layman term, in Google terminology, what nudge is basically to poke, to prod someone, to give a little push to someone. So in psychology or behavioral economics literature, nudge is something which is you are bringing something into the situation which will push somebody to do something good or something positive or to have a positive behavior. So this area of using nudge and designing nudges has been very exploratively explored in the behavioral sciences, specifically in the area of retirement planning. I'll give you a few examples like automatic enrollment. So there was a research done by AARP, report was mentioned, the AARP report in 2018, and it was seen that the enrollment spur for the enrollments for retirement planning increased by 15 to 20% when an employee was auto-enrolled in the retirement plan with an opt-out situation, as compared to when they were asked for having a voluntary participation. So that score was about, the difference was about 15 to 20%. And when people get enrolled, they are very less likely to opt out. So this is a nudge where the auto-enrollment is there. Another is save more tomorrow. So it's a smart plan, it's save more at the date tomorrow plan. And this is another kind of a nudge which was been designed by Taylor and Nardi, and lots of research has been done around it. And I'll mention one of the research where 3 treatment groups were designed. One was working on having a smart plan where they have to invest, they pre-committed, dedicatedly, they will be increasing their investment starting from 3%, they will be increasing their investment per pay raise by 3%. Another group was told, and another group was just saving as a one-time investment for your saving plan. Another group was the last group actually refused to make any such commitment, and they made their own retirement plan saving patterns. And eventually it was found in the research that the people who joined and they took smart plan, by the fourth pay raise, so you can just see this chart, by the fourth pay raise, they were about to raise 13.6% of their savings into the retirement planning, whereas the second group who made immediate one-off-time saving, so they were about to raise 8.8% as their investment or as their allocation to the saving plan for the retirement. And the third group who actually declined the advice of having one-time saving or having a smart plan, they were only able to raise 6.2%. So this is the nudge. This is how the nudge has actually worked. And where people have pre-committed to a particular percentage, it could be any, it could be something which could be advised by your advisor, and the advisor can tell you, okay, this is 3% or this is 5%, this would be 2% depending upon your expenditures, depending upon your other savings, depending upon your number of dependents, etc. So this is a nudge which they have actually used. Another nudge is facial age progression. So in facial age progression, what basically happened is people are divided into two groups. In this particular research done by Hirschfield, people were divided into group 1 and group 2, and group 1 was a current self group, and group 2 is a future self group. I'll explain how it is current and a future self, and all these people were taken into a collaborative virtual environment. In the group 1, they were actually asked to see, or they were actually shown their current self. All of them were shown their current self, what and how they are looking like. But in group 2, they were actually shown, and they went into collaborative virtual environment. They saw their old faces. They saw their faces after, say, 40 years or 30 years. They visualized their old self. And when they all came out of that particular environment, virtual environment, they were asked a lot many questions, including the emotional filler questions, and emotional tests were also given to them. But majorly they were asked to allocate money for their retirement plan. It was found that because of this nudge itself controlling other factors and showing the age progress picture or visualizing age progress photo of your own, people who were there in the group 2, they actually allocated twice the amount as compared to the group 1. This is the impact of a nudge. So these are small pushes, small things which are taken into account when you push somebody to take a particular decision. Another method of overcoming these biases could be automating. That is, automating, externalizing, or objectivating your work. And in a research specifically done with the advisors, it was mentioned that advisors should take time out and should use maximum time for uplifting their professional upliftment, specifically updating themselves with professional courses, or how they should be dealing with their clients. Another aspect was covered that they should be saving and utilizing their time more in communicating with the clients and making more money. Instead of taking many decisions which can be externalized, which can be automated with the help of softwares, where the human intervention is less, where the probability or scope of hindrance by these psychological or these behavioral biases is pretty less. So automating is another extreme approach which is generally taken. It's a good approach. I say extremely because it's extremely proficient in objectivating and objectivizing the entire scope of facing problems and then leading to quality decisions. So for example, I'll give you Morningstar's example how we incorporate these areas of not falling prey into biases into our automated systems. Like in the retirement planning module, we're using a lot of nudges. We're taking insights from these specific researchers which I've just mentioned. So we incorporate the insights from the existing research on nudges, and we are incorporating the intention-based nudges in that particular platform. Another could be financial planning tool where we incorporate risk reactivity, or where we incorporate our insights from the studies which we have done in the area of psychology of money. That is one area. And on the Morningstar's investment management team, which is working from decades from now, they are using and they are working on certain principles which takes into account all different biases which I have just mentioned over here. Our ethos actually work for every tool, for every software which we design. We use those ethos to stay away from certain behavioral biases. So this is the power of automation, and this which industry is widely working on designing tools and automating things to not fall prey into different biases. Another could be research-driven heuristics. So as I said, the core focus of the entire behavioral finance is to understand human mind, is to design and identify, not design, but identify various biases and how they work into the human psychology, how they work and have repercussions and implications for different people, and specifically in the investment industry. Further developing different tools for overcoming these biases. And last is research, designing research-driven heuristics. So yes, we are human beings. We love to act quickly. We love to act the way we want and take decisions as soon as possible. So in the example of buying a shirt, we were using past experiences, our gut feeling, our how people are working over there, or making decisions. And lastly, could be how price as an important factor has been taken into account. So we were working on these heuristics, but these cannot be replicated into investment industry. So here, what we do. Here, behavioral finance practitioners are actively working on designing certain research-driven heuristics. So, for example, if I talk about an example from the Morningstar community itself, the way we design, so the analyst rating, the category rating, or the mode, etc., or the star ratings, which we have, you might be aware of all those rating styles. So these are actually well-researched or data-researched heuristics or data-researched methods, quick methods are given to us, which are based on fundamentals and fundamental analysis of different stocks and funds, etc. And we always believe in valuation-driven investing. So all these factors are taken into account. All these factors are taken into account while researching and designing certain heuristics for the market. So this is what industry is actually doing, and where investors and advisors can pretty well be very confident about all these analyst ratings or all these ratings which are coming from the industry. And the last main important factor which has been taken into account or is important is behavioral coaching. So what is behavioral coaching? I'll give you a serious example, as you all might be going to fitness regimes and following fitness regimes, going to gym, going to fitness centers to maintain your bodies and to have good metabolism, etc. So what you basically do, you go with a problem to a gym, or you feel that something is happening wrong with my body, I should go to the gym, I should meet the instructor, I should meet the nutritionist. And then instructor or the nutritionist or your coach actually observes you, actually understand your goals, actually understand your circumstances, situations, and then also understands your existing plans, make changes in the existing plans, see and observe what are behavioral habits or what are behavioral trends you are following and what is leading you to in this particular situation. They might give you a particular set of regime also to follow or a particular set of diet also to follow. This is what a behavioral coach is doing over there, and that's a fitness coach, I would say. But as advisors, as asset managers, as professionals of the industry, we all need to become behavioral coaches for our people, for our clients specifically. We should understand what their goals are. We should understand what biases they are going through. We should understand what they actually need and how we can change that particular behavior. So this is what a behavioral coach is good at and should be good at, I would say. And they should map the gap between, there's a term called behavioral gap. So behavioral gap is basically what an investor or client should do and what an investor and a client is actually doing. And it's a gap between somebody's intention to do something and behavior to do something. So their behavior is pretty way far from your intention. So in a research done by Morningstar, it was found, so there in that particular research, this list of attributes were given to both the advisors and the investors, and the investors were asked that please pick and rank in a particular order of priority at which all attributes you value in an advisor. On the other hand, the same list was being given to the advisors, and advisors were asked that which all attributes you think your investors or your clients are valuing in you. So there was a lot of agreements, there were a lot of disagreements as well, and all these disagreements in the disagreement list, one of the major important fact which was being highlighted by the investors was that they need to stay, they want their advisors to help them staying in control of their emotions or managing their emotions. But on the other hand, when it came to advisors, it was seen that this specific point was kept as the least important. So understand your clients. This is the market. This is what your clients, your investors are asking from you, are demanding from you. They want you to be your behavioral coaches. They want you to be understanding themselves, helping them throughout their biases. And how you can do that? First, you have to educate yourself. You have to understand what all these biases are, how I am getting affected or influenced by these biases, and how I can work towards overcoming these biases in myself. Understanding your clients' biases, how my clients and what are situations they are going to face these biases, and make them also understand. So education is something you have to fuel yourself with this particular information. You can read a lot of books. I can suggest a lot of books where you can start working with. We have designed an advisor's guide also, which I'll be just mentioning from now. We have designed the advisor's guide also over here, which is simple but not easy, which is a very beautifully designed guide where all the intention-based and critically driven interventions have been mentioned to use by the advisor. It's a beautiful guide for the advisors to understand what all different types of investment advice go through and how you can intervene in many that. That's one area. Another way to become the behavioral coach is basically to change the point of reference. So generally, we have herd mentality, all investors have, we also have, we follow others. We generally follow and ask our significant others or relatives or friends. So as behavioral coach, you change your reference. You change that this is something which is not for you. You have to work around maybe giving them examples of those giants of the or investment giants or investment bulls like Rakesh Jhunjhunwala and Jim Borders or George Soros. So any of these can be your examples. You should be good at reading and you should be giving examples from these from their lives. You should give examples and say that this is the way they have been taking and handling situations when the markets are up and the markets are down. But now this will create an urge into them to read more about them, to replicate their specific behavior. Another could be setting SMART goals. When I say SMART goals, so SMART goals are basically specific, they're measurable, they are attainable, they are relevant, and they are time-based, and tell them to pre-commit to that. And see how they are maintaining all those goals. So these are different ways how the industry and the behavioral finance is actually working and utilizing the insights from the behavioral finance team and the different practitioners working in this particular area. So yes, this is how behavioral finance takes into account all these behavioral biases and different overcomings and design certain tools for overcoming these biases. And if you're interested to read more onto this, please come to the website www.morningstar.in or you can write back to me at sagneet.or@morningstar.com. Thank you.
Thank you, Sagneet. Thank you, Sagneet. That was very insightful and well detailed. I'm sure investors must have had like a lot of takeaways from there. But since the presentation has exceeded the time and it was quite gripping, we were allowing some extra time for the question and answers, basically. So,
sure.
So the first question comes from me only. While buying a stock or when one goes shopping, is it the same behavior at play?
So yes, when you talk about buying a stock and buying a shopping, anything particularly specifically, for example, I give you an example of shopping. Yes, you are making a decision, but yes, the decision is different. There is a consumption decision when you're going and buying a shirt, but when it comes to buying a stock, it's investment decision. But the psyche behind or decision making behind both of these decisions, both of these are financial decisions, but both these decisions have to be taken care by the psyche. You have to follow, you have to see, and you have to be very aware of what strategies you take into account. Where I mentioned the system 1 and the system 2, which is where system 1 is more active and more fast, but system 2 is more relaxed, more slow, but more technical, more logical, more rational. So we have to be mindful where we have to apply system 1 and where we have to apply system 2. The strategies are very different when it comes to buying something from a mall, like buying a shirt or choosing a restaurant, as compared to when it comes to buying a stock.
Sure. So the next question is from Shrikant Padi, and he asks that often a fear of losing money leads to a non-profitable trade in the market, which would have been an awesome risk-reward proposition. So what are your views on this?
Absolutely. So fear of losing is basically related to loss aversion, and fear of losing is basically related to the pains we feel from the losses itself. So this has many repercussions in the area of reward and risk proposition. So for example, when a person is high on loss aversion and he's in a situation of he has a fear of losing money if he sells out his stocks, and I would say which is more closely related to the feeling of regret as well, that you lost something and it's giving a pain to you. So this is basically related to two types of behavioral repercussions. One is holding on to stocks. So you hold on to a lot of stocks which you feel that yes, they might give you a pain when you will sell it. So you speculate that the market and you feel that yes, if I sell it, definitely this is going to lose, or I have good amount of probability that this will lose, and this will lead to, again, your risk appetite will decrease and your reward will definitely decrease over there. So you, instead of becoming a risk taker over there, instead of doing opposite, you generally fall into this particular bias where you feel that risk is more and pain is more around the risk, and you actually do not sell the thing. So you either hold on to certain stocks, or you sell certain stocks very quickly. So just when you get into the market, buy some stocks, and then you get out of the market itself. and you sell it very quickly. And these could be the profitable stocks, which if you might have waited for a bit longer, you might have rewarded well as compared to the one. So you become, the risk decreases over there. Yep.
Okay, so Ekta Sandhya asks the next question. Why the investing behaviors of two similar people with similar income profiles differ?
Okay, so this I think is led to many different factors. So for every kind of a behavior, human beings, two people like we two people, any two people cannot be similar. So psyche for any two people cannot be similar. In economic terms, circumstances of any two people cannot be similar. So what I might be going, maybe my and my colleague might be having the same level of salaries, we might be having the same situations to a greater extent, but the kind of psyche, the kind of behaviors we have, or the kind of personalities we have, or the way our mind works, is very different from what a person's mind is working. I might be more emotionally driven, the person might not be emotionally driven. He or she would be more practical. So the personalities, the internal factors as well as the external factors, like income profiles can be similar, but internal factors are generally very different from person to person. So we cannot say that the same behaviors will lead to same type of rewards to the two people. They're similar to people who have the same profile.
Okay, so the next question is from Nisha is behavioral finance about machine learning in finance, or is it a data science, or is what she's asking?
Okay, if I talk about these data science and machine learning, so nowadays, and I come from a research background, so I would take that into account as well. So machine learning and data sciences are now supplementing the analysis in the area of behavioral finance, is helping in designing both of them equally, depending upon the nature of the problem, depending upon the nature of the research. We see that when we have to apply a machine learning algorithm, or where we have to apply a data science algorithm over there. So we use these methods to come up to analysis. Earlier we were using tools like SPSS and researching, doing parametric analysis with maybe the simplest methods. But now these engineering oriented like machine learning came from engineering field, data science came from engineering field. So all these methods are now acting as an important aspect of answering the research questions, or are taken into account. So they are equally, I would say, I cannot differentiate between both of them in terms of here we will apply machine learning or here we will apply data science. Both are equally being used in this particular area of designing behavioral financial tools and products and data related interventions.
Okay, so I think that is a very, for a first time investor, I think is very relevant. So Mani, we ask, as a first time investor, how can I benefit from the knowledge of behavioral finance?
Okay. So I would say as a first time investor, or as the investor who has been investing in the field of who has been investing from the last 10 years, 20 years, I think when it comes to behavioral finance, both of them run similarly. For a first time investor, or for a person who is running their business from last 20 years, understanding different behavioral biases and how they play a role into their lives is very, very important. So for them equally, all of the, whether it's a first time or whether it's a expert investor, they run equally, I would say. But yes, when you are expert in a particular field and you are first time investors are more susceptible, or the probability of falling prey into these behavioral biases is more as compared to an expert who might have heard something about behavioral biases, or who might have observed through the experience which they have got. So that's the only difference. Otherwise, in case of behavioral finance, understanding these behavioral biases, understanding what psychology you are running with is very, very important. Whether it's a first time investor, or whether it's a investor who is leading a business from so many years.
Okay, so the next question from Arul Kumar is how to control your behavior during investing, and to put it in another way, how important is it?
It is very, very important, because managing emotions is something which is very, very important when it comes to investing field. So this is what I was telling about. There's a behavioral gap between what you should do or what you are doing, or I would say what is the intention and what is the behavior. So the gap is basically taken care by, or is basically obstacled or hindered by the emotions which we go through. For example, the markets are up or the markets are down. Specifically when markets are down, then we generally get very disappointed and emotional, and we want to take money out of our out of that particular stock. Or it might be when markets are pretty up, or the prices are rising, so we generally we get tempted by the news which is there on the television, and we get tempted and we end up buying the overvalued stock. So controlling your behavior is very, very important. And as far as how to control your behavior, so one important way is to understand it. Till the time you don't know anything, you will fall prey to that. when you are knowing any particular thing, definitely you will take into account, okay, whether I'm going into this particular field or whether I'm facing this particular bias or no, and what are the different repercussions I might be having if I face this bias or if I go like this. So for an example, if the markets are up or you are listening to the news, you know that the TV is actually valuing a particular stock, you should actually go back and research. So educating yourself, researching is important. Another is pre-committing. So for every investment or creating any portfolio, you should be pre-committing to certain rules of investing, which I think your advisor can very, very easily or can help you over there by pre-committing to certain standards. This is the way, these are the rules with which you will be investing.
Okay, so the next question that we have is from Sumesh Bagi, and he is asking that what according to you is key to successful investing, and how important is it to control your behavior? I think we covered that last bit. So what according to you is key to successful investing? Yes.
Yeah, so the key to successful investing is, again, I would say understanding yourself, understand these biases, researching a lot, analyzing a lot, taking help from automated and externalizing your job, taking help from these all beautiful softwares which are there in the market, which will help you refrain yourself from these behavioral biases. So these are the quick keys for having a successful investment life and earning more.
Okay. So the next question is, do we have a specific course to pursue behavioral finance, or what is the scope in the future? And this question comes from Prayas Nagpal.
Thanks, Prayas, for this question. So as far as scope of this particular field in future is there, so yes, there is a lot of scope of this particular field, and now the industry, not the investing industry, but yes, in general, behavioral finance and behavioral sciences are upcoming in the global and the Indian market as well. They are understanding this particular area into depth and the relevance of this particular area into different fields. So yes, scope is very wide, but how soon we will be able to reach that particular limit where everybody and every investing decision has been based by behavioral finance, has been backed by behavioral finance, that stage I cannot commit right now. And another question, do we have a specific course for pursuing behavioral finance? There are many institutes in India, if you're talking about India, so there are many institutes in India who are not now bringing this behavioral finance as in their majors. Many MBA institutes are also doing that. Many behavioral and experimental economics labs are being open, like in IIM Bangalore one is there, in Chennai one is there, in Pune in Symbiosis one is there. So we can explore all those courses. And apart from that, if you as a beginner and out of curiosity you want to learn about behavioral finance, there are very good books, like you can read Thinking Fast and Slow, you can read Misbehaving, you can read Nudge, you can read a little book on behavioral investing. So there are many such books. So these, I think these 4 books are one is Intelligent, I forgot the name, Intelligent Investor. So these are the books which are kind of basis, which can provide you the basis for the behavioral finance field.
I think a lot of people will appreciate this answer in the audience. Okay, so the next is from Abhinav Drop. He's asking how to judge if a particular stock has made its bottom, and does behavioral science offer any clue on this?
Okay, how to judge if a particular stock has made its bottom? This is a difficult question. We can take this question maybe lately. If Abhinav is okay, he can write back to me and I can research more around it.
Sure, we will definitely ask your next to do that.
Absolutely.
Okay. So the next question is from Chandramoli Hegde. She's asking, what is the millennial approach to investing, and what does your behavioral science say about this?
Okay, so when it comes to millennial approach to investing, so everybody, whether it's a millennial in a millennial age range, or if it's working towards midlife or mid-age or the old age, the problems and the responsibilities and the situations are pretty different. And it varies from culture to culture. It also varies from country to country as well. So if I talk about India, taking an India example, when I talk about millennials, so nowadays what, not behavioral science, but in general what the research is saying is that millennials are now more open towards changing jobs. They are more open towards starting their jobs early. They are more open towards living a lifestyle which is like, okay, whatever you earn, you invest or you utilize or consume that particular amount in a particular month, and by the end of the month you generally are broke. So at that point of time, when it comes to investing and when it comes to saving, first you have to start with the saving. So your savings, you have to make a budget. So budgeting is very important. Saving is very important. Saving for future can come a bit later. Maybe if you're a first joiner in your job, maybe this is your first job. You can just think about managing your money in terms of saving, budgeting a lot, saving some amount for any kind of investment. Maybe you just put the X% of amount every month into a bank account. Okay, not specifically buying a stock or something. So eventually first the habit should be built properly, because the trends are very different, because you see so many people, so many colleagues, so many friends working on and leveraging a different kind of a lifestyle. So understanding your lifestyle, understanding your needs, budgeting yourself, planning about, okay, what my needs could be after 10 years, what I want to achieve in my 10 years. After 10 years, maybe I will buy a house, maybe I should be having a car. So apart from the luxuries also, if I'm married, so what kind of an amount I would be needing. So analyzing your needs, taking a small range of years, 5 or 10 years, will help you estimate that what kind of saving levels you should be having. And then start with smaller amounts, you can start investing in mutual funds or SIPs, or maybe you can, tomorrow after 5 years, you can start your retirement planning and start with small investments to begin with, just as a baby steps. And then when you are earning more, because by after 10 years or 5 years, you will be earning more. You will be in your second or third job maybe, and you will be more proficient, and your professional skills might have increased, and you're in a job where you're earning more. So with your growth rate of income, you can add on to certain investments.
Okay, Sagneet. So since we have a dearth of time, I'll be just taking 2 more questions. I hope that's okay. So Amrish Mathur asks that when stocks fall significantly, how to work on your own brain to analyze if it will fall further or is it close to its bottom?
Yeah, this is a question which is like is something which almost every investor faces at every now and then when stocks fall significantly. So your brain's working, okay, this will fall more, this will not fall more. I would suggest this is a similar situation when it's generally like when the market falls, we get panicked, we get emotional, and we are not able to speculate the time when this is going to stop. And day by day, moment by moment, we are getting emotional about the investment or the money lost. I think in this particular situation, we should go back to the pre-commitments which we have made in the past about our investment. So that I give you an example of with the help of advisor, we should be having a rule-based investing methods we should apply. We should be focusing on the SMART goals. And when you design certain goals at the initial level, you have to commit to that, whether the market is going up, whether the market is going down. No matter if the market is going down, stay calm, stay at your place. It will be coming up. Your stock will definitely, after maybe 6 months or 5 months, will be coming up. So it's important for you to understand your brains, understand your emotions, and stay calm over there instead of panicking or taking money out of that particular situation. And research was a very beautiful research was being done in this particular area. I would say that generally what people do in such a situation, they pull out their money. And eventually when the market goes up, they lose a lot of money over there. And this is what is, we have to be recommitted to our older commitments which we made initially for making when we were designing the portfolio. And then taking and not bothering about all these markets ups and downs.
Okay, so the last question that we're taking today is from Kiran Babu, and he says that basically he's asking that besides the risk appetite part, how else should a person's investing behavior change post-retirement?
Okay, besides the risk appetite part, how else should a person's investing behavior change post-retirement? Okay, so as far as retirement is concerned, I would say the way you have been investing, I don't know whether this person is Kiran Babu, I don't know the age of this person particularly, but if I talk about myself, taking this example, taking this question, when it comes to pre-retirement or post-retirement, generally when you plan for your particular retirement and retirement age, so in US, for example, your retirement age can be delayed, but in India, the retirement age cannot be delayed. So your planning plays a lot of role. So how you plan will decide how you will be investing post or pre-retirement. Gradually, you will not be, yes, definitely, your retirement by the time of your retirement, post-retirement, the changes in the investment allocation will definitely change across asset classes. But how you plan it before, if you are able to plan it like that, if you're able to plan it the way and managing, for example, you keep a need. So today, for example, managing your existing expenditure, savings and investment, and X type of investment allocation you are doing. For that, you need an X amount or P amount, and then you speculate and say, okay, if I'll get retired at 65 years of age, and this is the amount, the same amount I want that time, maybe taking into account the inflation or the growth rates, etc. You will say an X plus amount, so Y amount I want over there, and you start planning for that Y amount. You start allocating your small amount of money till that point of time. So definitely, you will be able to reach that particular need and invest the way like you are investing right now. This is what I would suggest.
Okay, Sagneet, thank you. Well, I'm afraid the audience that we will have to wrap it here, and we could not answer a lot of your questions because of the dearth of time. But I have some good news that ETMarkets and Morningstar has just launched an initiative through which Sagneet and her team will be engaging with us through regular call-ins and webinars over the next few months. So you can log on to ETMarkets.com to dive deeper into this phenomena called behavioral finance and make the best use of it in your wealth creation journey. Well, thank you so much, Sagneet, for your time and for the engaging discussion. I enjoyed it a lot. I hope you had a good time too.
Yes, I did indeed. Thank you so much, Saloni, and thank you so much, everybody in the audience, for taking out time, 1.5 hour for me and listening to me. You can write back more questions to me on my personal email ID, sagneet.kaur@morningstar.com. Thank you so very much. Thanks, Saloni.
Thank you. Look forward to having you some more time. Thank you.
Thank you.